Good morning, everyone. Here's your latest market update for today. So, starting with the US dollar index, in the first half of the week, the US dollar weakened broadly against the euro and Japanese yen. The weak ADP employment data and the ongoing government shutdown pushed the dollar index down to 99.29, a near 1 week low and a key pivot level. So, according to the ADP estimates, the US private employers laid off 11,000 workers per week in October, significantly undermining the market confidence in the labor market. Concerns are rising that once the government reopens and official data resumes, the further confirmation of an economic slowdown may follow. If the bullish traders cannot aggressively defend 99.29 and the psychological level of 99, the dollar index may continue to slide. Rising expectations of a December Fed cut also limits the dollar's recovery potential unless the upcoming data surprise meaningfully to the upside. And from a technical perspective, breaking below 99.29 and 99 psychological level leaves the dollar without strong nearby support. The next major downside reference is the October 28th low at 98.57, just under the 50-day SMA at 98.5. If bearish momentum persists, the 98 psychological level becomes a logical medium-term target. And on the upside, a short covering rebound cannot be ruled out once the government resumes full operations and data begins flowing again. Immediate resistance stand at 99.87, followed by 100 and 200-day SMA at 100.13. So moving to WTI crude oil, the oil traded around 58.5 during the Wednesday European section, down more than 4%. Tuesday saw a brief rebound supported by US sanctions on Russia and hopes that the US government shutdown may be ending, but concerns over oversupply continue to cap upside momentum. The US sanctions on Russia's Luke oil have it disrupt the company's operations in Europe, potentially affecting winter fuel supplies in several countries. Bulgaria has revealed it has only about 1 month of gasoline reserves, highlighting growing fragility in regional energy security. Oil markets currently face a tug of war between geopolitical risk and softening fundamentals, with traders assessing how sanctions may eventually affect global crude and also refined product flows. And technically, for the past 3 weeks, WTI has repeatedly tested the Bollinger Band midline at 59.6, showing strong support. Attempts to break higher have pushed price above 60 and briefly above $61, though the upside remains limited. The 14-day RSI at 41 reflects moderate near-term weakness. If price regain and hold above $60, the upside potential opens to a 62.38. And on the downside, if WTI falls below $58, further declines could target 57.31 and also the 57 psychological level. Next, spot gold. Gold traded around 41.95 per ounce in early European hours on Wednesday, gaining more than 1.5% and reaching a near 3 week high. Expectations that the US government shutdown may end soon and that economic data will resume have strengthened bets on a potential December Fed rate cut. As a result, the dollar index continues its 5-day decline and stays near 99.29, supporting the precious metals. Gold and silver markets are benefiting from the combination of a weaker US data expectations, rising rate cut probabilities, and also persistent geopolitical uncertainty. Analysts also expect gold demand in 2024 to 2025 to reach its strongest level since 2011, providing a solid medium to long-term floors for prices. Earlier this week, gold finally broke out of its 2 week consolidation between 3,900 and 4050, and then surpassed the near 3 week high at 4211, confirming a bullish breakout. Immediate resistance lies between 4200 and 4250, and a decisive push above this band could accelerate the momentum towards 4300 with a potential retest of the all-time high near 4381. The 14-day RSI near 63 suggests bulls still have strength, but may face temporary consolidation before the next impulse higher. Key support levels lie at 4100 and 4050, the upper boundary of the previous consolidation. Last but not least, the Australian dollar. The Aussie dollar traded around 65.40 near a one-week high supported by the comments from RBA Deputy Governor Andrew Hauser. And Hauser highlighted the unusual challenges facing monetary policy and also emphasized the need to maintain tight policy to curb inflation. He noted that the demand exceeded potential levels last year, leaving limited room for strong expansion without sparking renewed inflationary pressure. And earlier this month, RBA kept rate at 3.6%, though markets expect the next cut before next year. Meanwhile, Australia Westpac Consumer Confidence Index surged 12.8% to 103.8, marking a 7-year high and the first reading above 100 since 2022. Improved global risk sentiment, especially optimism surrounding a potential end to the US shutdown, also supported the Australian dollar. And technically, this pair trades in a tight range above 65 cents, with the 9-day SMA at 65.18 showing a neutral short-term bias. A break above the 40-day SMA at 65.40 would allow the pair to test 66 cents. And on the downside, losing 65 cents could weaken momentum and expose the pair to 64.53 or 64.14. So to wrap up, the markets are in a wait and see mode as investors look towards the end of US shutdown and also the return of key economic data. The dollar is struggling for direction, while gold and Australian dollar are finding a support from improving sentiment and shifting rate expectations. As fresh data begins to flow again, we can expect clearer trends to emerge and volatility to pick up. So trade safe and I will see you soon.